Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by my company, Bull Realty. For custom asset and occupancy solutions, visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. Well, we have a great show for you today. One of my favorite economists in the world is here, K.C. Conway. He's the lead economist for CCIM. And it's always interesting, K.C., to hear what you have to say and what's going on, really going on in the world and the economy and in real estate and what to expect moving forward. And that's what we're going to cover. And I think the first thing I'd like to start off with, I think my audience is curious on your thoughts, K.C., is, the Fed has announced that they plan some hikes, interest rate hikes. What do you think might happen there? And what do you think the impact could be?
Yeah, it's the central point of focus. And remember, this is the same Fed that 6 to 9 months ago, 9 months ago said there really is inflation. And 6 months ago, they said, well, it's kind of transitory. Then they said by the end of summer, it's kind of going to be transitory longer. Then the end of the year, it was, okay, forget transitory. It's here. It's embedded. And remember, a year ago, they said, look, no rate hikes, no change in the balance sheet till 2023 or 2024. What in the world were they looking at? Because you could see all this coming at us. So if you set up the first quarter, they have a meeting here this month. They have none in February and then in March. If they don't move in rate hikes here in January, I think they're so far behind the curve, they will have totally lost the battle. And if they wait till March, my forecast is 4 to 5, maybe 6 rate hikes this year. Whoa. And one of them could be a 50 basis point hike. If they wait till March, the steam that we have, we just got the new CPI data, 7% year over year, highest since I was starting college 40 years ago. And they're not looking in the right places. If you look at whether it's, go to the grocery store and look at what's happening. Look at used car prices at 50%. Look at energy prices at 50%. How you can't see these things is really beyond my perception. Mm-hmm. And, look at housing and rents. And, we have 148 of our 150 multifamily markets that are at 96% occupancy and running 5% rent increases. How can you miss inflation? So I think it is going to be the story. And what concerns me is just in the past week, we've seen a 25 basis point movement up in mortgage rates, and we haven't even had the first rate hike. So wait till we have the first rate hike.
Yeah. Wow. Well, Casey, what do you think the impact will be on commercial real estate values? It seems like sometimes I hear that, the market's kind of built in some increases that have been so low that it's expected. What do you think?
Yeah, so I remind, being a scarred third-generation appraiser, go back to the fundamentals. So the first thing that concerns me, first thing I'll say is generally commercial real estate does well in an inflationary environment. Go back to the 70s, it goes up because the replacement of any other office building or whatnot is going to cost more. So generally it does pretty well. Rents tend to go up. You get CPI escalations. So if CPI goes up, you get more rent escalations. But here's my concern, is that expenses are outrunning revenue or rent growth in most commercial property types, even industrial right now. And so if your expenses outrun your revenue or rent increase, and then you get interest rate hikes, which is going to have an impact on cap rates, and they don't continue to compress and they go up, what happens to values? They've got to correct. And we've had an incredible run. Last year we had 66% increase in self-storage. When does that ever happen? We know where everybody put their stuff from New York and California that moved down to the south. You had industrial at 40%. You know who number 3 was? Yeah. It was a tie with retail and lodging, up over 30%. And the bottom coming up was multifamily, just 25%. These are unheard of increases that don't happen every year. I don't think the market's adjusted to that. So I think we need to be very careful, sharpen our pencil, look at our DCF, do sensitivities that what happens if expenses outgrow rents for the next 2 or 3 years? And then what's going to happen naturally in the debt cycle? Be more debt service coverage required to get debt. They're going to require lower loan to value, more equity in the deal that's more expensive. So I think there's going to be a lot of pressures. And the real question is going to be, where can I outrun inflation geographically and by property type?
Yeah. And part of those increasing costs are in materials, the supply and the availability of construction materials and all types of materials. And then also rising labor cost. What do you think about those two issues moving forward and their impact next year?
You're always so wise. You have your crystal ball going. So you're exactly right on the construction cost. And don't think of just new construction, but think about moving a tenant. because they got to get sheetrock, they got to get laborers, they got to redo the studs and all. So the resource I follow is ENR, Engineering News Record. And so back in the spring, they were telling us that they have a construction cost and a building cost. So the construction is just the materials, and the building is materials plus labor. So each of those were going up about 4 to 6% last spring. They ended the year up 8 and 15%. Ooh. And it's not just the cost of the materials, it's if you can get them. And how can you absorb the delay? So let's say you have a construction loan that's got a 2-year term on it, and now it's going to take 3 years to get everything done. And then the labor. Your labor might show up, but the labor says, I got another job down the road. He's going to pay me 20% more. I'll stay and finish this job, but you got to raise me 20 or 25%. So the labor numbers are off the charts. If you can get trucking, try to get heavy equipment to do the site work. Our REIT, we try to develop a few buildings here, and we just can't get the site work. Can't get the heavy equipment grader. You can't get all that stuff. So you're exactly right. If you're doing construction or you're moving a tenant, my warning to the banks is you better be paying attention to your construction loans, because you're going to have cost overruns, and who's going to pay the bill? And the bank's supposed to make the developer put some in, but that's not the way it always works.
Might this increase in construction materials for supplies, the supply chain issue, might that be subsiding here? Might we see a decrease in any of these costs?
Yeah, not yet. But the encouraging news is if you're in the southern United States, so if you're in where you have Gulf Coast ports and come around the south, Florida, Port Everglades, Savannah, Charleston, but we're actually doing pretty well. We have the rail connection. The rail bone is connected to the port bone. Here in Savannah, where we set a record, we're going to surpass New York in container activity when the numbers come in for the end of 2021, which will make Savannah the busiest container port on the East Coast. It'll basically be the LA of the East Coast. Charleston's the fastest growing port. Port Everglades is crushing it. Port of Mobile is going to be renamed the Port of Alabama. It could surpass Charleston. It's been a completely redone port from bulk cargo to containers. So it could surpass Charleston. So we have all of this redundancy for supply chain. We can have stuff come out of Panama Canal into the Gulf and come into our region. Mexico provides a lot of components. And then on the East Coast, we're doing fine. Even New York, which is losing ground to Georgia, because everybody moved down here and they ordered their golf clubs and stuff down here rather than up there. New York was up 28%. So we're seeing on the East Coast, we have logistics infrastructure that makes it work better. The West Coast has a lot of complicated problems. And the biggest one is not that union labor is not working 6-7 days a week. It's that you can't stage the stuff on the port and move it inland to the Inland Empire because all the warehouses are full. And Prologis, I like looking at earnings. Prologis in the third quarter earnings said we have almost 1 billion square feet of warehouse space, and we're 97% plus occupied. We have no room to put anything in a warehouse.
Yeah.
So until you can unpack that whole problem, we don't have that problem here in the South.
Yeah.
So Texas all the way through the Mid-Atlantic.
And do you think, K.C., that the rising rents in industrial and in multifamily, both those markets, as you mentioned earlier, have been just crazy rent increases over the last several years. You think that should continue? Might it continue?
Yeah, so industrial, I'm very bullish. Look, we're going to build 350 million square feet again this year. We could build 500 million square feet a year for the next 3 years and still not catch up. Because where we're building this new e-commerce infrastructure and warehouses, it's not where it was before. It's not in the Inland Empire. It's not on the West Coast. It's here in what I call the Golden Triangle, the Great Lakes down to Texas and across, the Southeast. So industrial, I'm very bullish. And, I've got an industrial REIT. We're selling it right now to ILPT at a record 4-point-something cap rate and almost, $200 a square foot, unheard of. Wow. And they're all in secondary cities. So these aren't, New York and big cities. Most of them are in, Augusta or Ogden, Utah, or, smaller markets, Huntsville. And, there's no pushback at all. They just say, just get me the doggone warehouse. And I don't care about rent per square foot. I don't care about cap rate, because if I get it wrong on my supply chain, that could cost me 20%, where my real estate's only like 3% of my total operation cost. Mm-hmm. So I don't care. So I'm very bullish on industrial and what we need to build. And then on multifamily, think about the two most current statistics right now. 148 of the 150 largest multifamily markets are at 96% occupancy. That tells you got the demand to basically continue to raise rents and to continue to build product. And we're going to build more, we're going to deliver more apartments in 2022 than we have at any point since 1987. Over 400, apologize for that, Over 450,000 units is what we're going to deliver this year. Not since 1987. So multifamily and industrial very strong, and I wouldn't throw retail or lodging out. Those aren't terrible.
Well, let's talk about retail and get your opinion there, because it seems like retail sales, we're doing pretty well. Where are we now?
So we got retail sales numbers today that were horrible. They were down 1.9%. But we have to, it always amazes me that the analysts and the investors in stocks can't connect two dots. So what were we told last September and October that changed our behavior this year in retail sales?
Buying early.
Santa is not going to have anything going at the warehouse warehouse factories with the elves in November, December. So you better order everything now or you're not getting anything for Christmas. So we all ordered early. So we got all of our orders in October, whatever. So that's having an impact on December numbers. And the December numbers, the biggest decline was online ordering because they all were record numbers in October. So that's part of it. The other thing that's affecting is, put that aside, you can't get inventory. You can't get a new car. It's hard to get furniture. It's hard to get appliances. So if you don't have those things to sell, they don't flow into the retail sales number. So part of it is you just don't have the goods that are coming in, that are being manufactured. And then what we really did need, we ordered last October.
Yeah. When you look in your crystal ball and you look at, you said, hey, the ports are starting to free up. We're starting to get the supply chain kind of working a little bit better. Are we going to be able to get those cars and get those furnitures faster toward the end of the year? When does it free up?
So a lot of it's going to depend not so much on us and how we're managing COVID and Omicron. It's going to be how China is. So China is third largest port. I'll pronounce it wrong, Dailin. So they just shut down. They had 2 COVID cases, 2 in the whole port city. And they shut the whole thing down. And they put 5 workers in jail for 5 years because they took their mask off for a minute. That's how ridiculous it is. Well, what do they make in that port? So in China, we got to remember all the manufacturing occurs on the port. In the United States, we have everything manufactured inland and we ship it to the port. So when you shut down the port, you shut down manufacturing. But what do they manufacture? Intel chips, what we need. So I'm really worried. You got to understand what's going on in South Korea. You got to understand what's going on in China and their ports. And then these geopolitical tensions and, maybe like a Seinfeld episode, no chips for you. We don't like your behavior.
So it sounds like you're suggesting inflation's going to be here for some period of time then.
I think this is a 2 or 3 cycle. I've had a thesis since the beginning of last year that this was shaping up to be a 1970s style inflationary cycle. And the reasons were something that we hadn't seen in 4 decades. So first one was rapid deficit spending. What did we have going in the 70s that was rapid deficit spending? Vietnam War. If you read the headlines from the late 60s going into the 70s, they almost look like exactly what we're saying today in our deficit spending. Number 2, you had Nixon take us off the gold standard. So they devalued the dollar. Well, we're devaluing the hell out of the dollar right now. Number 3, Nixon said, I have a great solution to stop inflation. Price controls. What's the Nixon's price control trick today? It's the Fed's balance sheet. Any mortgage-backed security, any 10-year treasury that won't clear at the price they want, they go buy it and keep it down. Now they're saying, oh, we got to pull back on that. So if the Fed pulls back on his balance sheet, guess what we have to have? We have to have greater fool theory. Who's the greater fool that's going to pay that kind of yield number that the Fed has been paying? Is it going to be China? Is it going to be Europe? Is it going to be institutional? And I don't think it is. So I think we're going to get real market discovery on a 10-year treasury and mortgage-backed securities. And I think we'll very quickly see 3-4% on the 10-year treasury by this year. And then the last thing is we had an energy shock. We had an oil embargo and an energy shock. What's the equivalent of the energy shock on our economy today? Supply chain shock. And so you put all those together, we haven't had that kind of convergence in 4 decades, and they're sitting staring us right in the face. And that's going to take years to fix.
And the increase in gas prices, right?
Yeah. So here we were energy independent, and we had the lowest gas and energy prices, and now we're not energy independent, and we're up 50% over a year, even though it's pulled back. And we can let Europe and Russia have pipelines, but we can't. It's just, you almost just wonder if we'd gone into went to sleep, had a really bad nightmare, and maybe we'll wake up and all this will go away. I don't know. Maybe the midterm elections will save us.
Especially COVID.
Yeah.
Right. So where are the opportunities today?
Yeah. So I think the big one is you ask yourself, if inflation's the problem, where can I outrun it? And there's certain geographies that you can outrun it, and there are also certain property types. So I wouldn't be long on self-storage. It just went up 66%. I might sell that right now really quickly. But I think industrial's there. I think multifamily is there. I think leisure hotel, and I think secondary markets. And one of the best things, if you really want all the, you got to read it a little bit, but I stole your copy out in the lobby, but Emerging Trends 2022 report, this is one of their best ever. I was at Equitable when they started these. And if you look at, they've got a couple of categories where they look at overall rankings, and then they look at where investors are saying they're going to put their money and where they're going to develop. And what they're saying is 8 of the 12 top markets for where overall the ranking are, they're all south. And the other 4 are the Intermountain region. They're Utah, they're Idaho, they're Arizona, they're Colorado. And then when you look at where they want to put, where investors want to go, again, it's the same thing. It's the South, it's Texas, it's the Southeast. It's not the West Coast, and it's the Intermountain region. But here's the warning, and this is really neat in here. When they say, okay, where would you develop? Where would you go take new money and develop new product? There wasn't one market that got a strong rating. That's the first time in the history of them doing this. So it was back close to average, and the reason is, how do I budget? How do I budget and line up labor? How do I budget costs that are going up 15% a year? How do I work with a construction lender that says, you can't have that kind of budget, you can't have that kind of cost overrun? And then when you do have the cost overrun, you got to go get an appraisal. What do you think the appraiser is going to say? My last number is still good. Oh my God. So I think it's the geography. I think it's still industrial. I think multifamily is strong. And there are a couple of others that people have overlooked. Manufactured housing. We only permit 100,000 lots. We have demand for 500,000. That's part of the affordable housing play. For rent subdivisions. You look at entities like American Homes for Rent, and just massively from Texas down through Florida, where they're building these for rent subdivisions. American Homes for Rent, I just visited their stuff in Central Florida, and I looked at their national numbers on their earnings report. They're at 97% occupancy on every subdivision nationwide, and they're the largest.
Wow.
So there's niches like that. I think there's opportunities to build on the carnage. I think we're going to see a lot of closed auto dealerships, the whole Carvana, TrueCar model. It's more efficient. What do we do with auto dealership land that's on good commercial arterials? What do we do with closed branch banks? Can we make those mini offices? I think suburban office is an opportunity over urban office, closer to the workforce, don't have a commute. So those are where I'm seeing some of the opportunities.
Those are great tips. What about tips related to rising interest rates for folks with existing properties?
Yeah, so if you've got an asset, you've got 2 challenges. The first one is, wow, I've had a good run. Should I sell it and cash in? And then you talk to your accountant and he says, oh my God, you got massive capital gains and we're not gonna be able to find a 1031 for you. It's really hard to find those. So you're really gonna have to weigh your tax situation and wonder, okay, I've come up this far. What happens if I come down 25% or gosh forbid 40 or 50%? Is that worse than paying capital gains and moving on? And then look at what's going on in Washington and what they want to do with changing capital gains and tax structures and all that. So I think that's the real problem. If you've got built up stuff, our Monmouth REIT that we're selling, most of us, our stock was around a $9 or $10 basis, and we're selling at 21. And it's not a tax exchange deal, or a stock trade deal. So a lot of capital gains, it wipes out really everything I made in 5 years. So everything I made goes to the tax man. So I think that's the big problem, is really balancing your gain versus your tax situation. And what do I do, or can I do a 1031?
Yeah. So consider selling. I guess also consider creating some long-term debt at today's interest rates, right?
Yeah, I would say look at if you have a loan that's maturing this year and even into next year, really look at the defeasance analysis. You may be so much better paying a little defeasance, even though you're not within that 1 year period. Pay that defeasance and refinance, because I don't think in my lifetime we're going to see rates this good and underwriting this good. I just don't think we are. Yeah,
we're brokers and we do a lot of business around the Southeast, and we're seeing some sellers that are, they're going ahead and paying the defeasance to sell at these kind of low interest rates, but there's a lot of supply of equity in the market looking for deals. There's also a lot of debt at really low rates still today. So people are paying the defeasance and moving on and taking some chips off the table in a lot of cases.
Yeah, and then think of leveraging. This is one of those times where you think really seriously about the CMBS market. So if I can go in and take an asset and put it into a single LLC, special purpose asset, and I can leverage out tax free the debt, and I can put that money to work somewhere else, put it in a trust for the kids or something else. That's how I harvest tax-free. And I had clients early in my career back in the 90s where we did exactly that. We helped them figure out how to harvest equity through securitization, go buy, upgrade better properties, and not pay any tax bill.
Yeah.
So call you and help get the mortgage stuff done.
There we go. K.C., what would you leave our audience with to think about for 2022?
So I would say, this is if you haven't been out and had Chinese food yet, and look at the zodiac calendar, this is the year of the tiger, and the tiger is the year of extremes and extremities. And I think it occurs every 12 years. So let's go back, 1974. Oh my God, Watergate, then the start of inflation. Then you go forward to 1986, the change of the tax law, the S&L crisis. Then go to 1998, Y2K, the tech wreck. 98 to 2010. Oh my God, have we forgotten about the Great Recession? I think this darn Chinese tiger is pretty accurate when he shows up, and I would be a little worried about the extremes. So I think go back to your Boy Scout, Girl Scout days. Be prepared. Don't wait like some of these analysts are that say, "Wow, what I didn't know the Fed was going to raise rates. I thought they told me they would only do 2 or 3, and they've done 5 or 6. Be prepared. They move when they move. It's never less than 8, and it's typically 8 to 12 over a 2-year period. So I think you need to budget. What does the impact of that mean if I have debt that needs to mature, if I have a construction loan that's coming due? I really need to be working with my mortgage broker or my debt expert to help me figure that out. And then on the purchase side, go south and go inland to the mountains. Don't go to. I wouldn't be buying anything on the on the West Coast, maybe except for the Inland Empire. But then you got to pay 2% cap rate. So where's the greater fool to get you out of that? But we really look at that golden triangle, the Great Lakes, which is our 4th coast, all the way down to Texas. You look at our Gulf Coast. You look at our East Coast ports. I'd look at markets that are connected. Really what I call the hip bone to the leg bone to the foot bone, the port bone to the rail bone to the logistics infrastructure bone. I'll leave one last other one, and it's bullish on us here in the Southeast. There's a corridor known as the I-85 corridor. Look at it if you haven't driven it, come down, drive from Charlotte to the Port of Mobile. It is absolutely incredible. The land prices are half of what they are on the I-75 corridor, going down to Savannah and going down to Florida. Hyundai has said they're going to put over $7 billion to work in that corridor. We are picking up major site selection entity after another one. In Montgomery, Alabama, they just announced an inland port, so they're going to copy the Georgia and South Carolina model. You got Amazon, you got FedEx, you've got automobile manufacturers, and Hyundai and Mercedes have declared that the 85 corridor is going to be their EV vehicle manufacturing epicenter. So what's going to happen on the 85 corridor, if you haven't studied it, go drive it. Your rest of your hair will fall out this year. It'll be extreme.
Yeah. And it sounds like your REIT is taking some chips off the table now while the getting's good, right?
Yeah, we're bummed. It's a great 53-year-old REIT started by the father and the sons that ran it, and they did a great job. And you have a good dividend. You're all triple net lease. You're what everybody wants, and they offer you a price that your stockholders don't say no to.
Yeah.
Good gig ends.
Yeah, I've seen some really smart long-term investors selling some properties today, right now, while the market is so strong and the lower interest rates. Because one thing it's kind of strange to look at right now is exit cap rates, right? If you're going to look at a 5 or 7 year hold, what kind of cap rate are you going to forecast?
Yeah. Don't ask an appraiser. Ask a CCIM, because they've done the investment management, not just the rear view mirror approach. I mean, I really worry that the CRE values is going to be a tough one this year. It's whether you're dealing with a debt person or you're dealing with a transaction. The equity in institutional money is trying to justify to an investment committee, why would we pay, so like our REIT, why would you pay 4.1% on a cap rate for all secondary market assets, whether FedEx or triple net or 20-year, it's the same stuff you pay 2% cap rate for in LA or the Long Beach. So they're trying to wrestle with that, and they're finding it a hard time to get appraisers that understand it. And then on the bank side, they're just sheep. They have no clue at all. Their internal appraisal departments are just, order it fast and cheap, get it in. Don't try to adjust the number because the regulators might criticize you because you adjusted it in some way. So they're looking in the rearview mirror. Appraisals are going to be really tough. Spend some time if you're doing a transaction to really interview and think about who is a good valuation expert, because you get the number wrong and you put all this due diligence money up. It's not pretty.
Yeah. KC, great information as usual, sir. Thank you for joining us.
Thank you. And got the new coat, went down to Miami, and
Yeah.
so the red shoe not only has red shoes, but we also have the jacket, the Miami jacket.
Looking sharp, looking sharp. Well, thank you for joining us around the country. Let us know what you think. Thank you for sharing the show, and thank you for being with us. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert-level commercial real estate broker training. Cloud Access 1 up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.